Have you ever come across a bond that seems to have it all? One that promises returns higher than a normal corporate bond, but with the kind of stability you'd expect from government debt? Well, today we're diving deep into the world of life insurance bonds. We're going to find out if they're really as good as they sound, what the catch is, and how they actually work.
So let's start with a really interesting question. What if a bond wasn't just a simple IOU from a company? What if it was more like an investment in the company's actual financial foundation? That right there is the fundamental idea behind life insurance bonds, and we're about to see why that distinction matters a lot.
Okay, to really wrap our heads around this, we have to start with the basics. What exactly makes a life insurance bond so different from all the other bonds out there?
On the surface, it's pretty simple. A life insurance bond is a loan you give to an insurance company. But here's the twist. Instead of using that money for, say, a new marketing campaign, they use it to directly strengthen their financial core. It's less of a loan for operations and more of a capital injection to beef up their stability.
Think of it this way. A typical company might issue a bond to build a shiny new factory or expand into a new market. But an insurer issues this specific type of bond to build up its capital reserves. So it's not really about growth and expansion, it's all about creating a massive financial safety net.
So you might be asking, why this intense focus on building a safety net? Well, it's not just them being extra cautious. It's actually the law. Let's look at the regulatory push that makes these bonds so common. The insurance business is all about managing risk, which is why it's one of the most heavily regulated industries on the planet. Rules like the Risk-Based Capital Standard, or RBC, and the global ICS 2.0 framework, well, they force insurers to keep a certain amount of cash on hand. It's proof that they can pay out every single claim, even in a worst-case scenario. And these life insurance bonds, they're a really popular way to meet those strict requirements. So, the big question, where do you stand if the company ever gets into real financial trouble? Well, because these bonds are treated like company capital, they're considered subordinated. Just picture a line to get paid back. At the very front, you've got the senior creditors, banks, regular bondholders, people like that. You, the subordinated bondholder, you're right behind them. And way at the back of the line are the shareholders. So you're not first, but you're definitely not last either. All right, so we get why insurers issue these things. But let's get to the important part. What's in it for you, the investor? Let's talk about the payoff. First off, these things are built for the long haul. Think about it. An insurer's promises, like life insurance policies, can span decades, so they need funding that sticks around for just as long. That's why these bonds often have maturities of 10, 20, even 30 years. For you, that means a really steady, predictable stream of income for a very long time.
Second, and let's be honest, this is the main attraction. You get a higher return. The yield on a life insurance bond is usually better than what you'd get from a super safe government bond or even a high-quality corporate bond. This little extra, this yield premium, is basically your reward for taking on a slightly different role in the company's finances. So when you put it all together, you can really see the appeal, can't you? For investors whose main goal is just a steady, reliable income stream over a long period, these bonds can look like a perfect fit. But, there's always a but, right? A higher yield pretty much always comes with a bit more risk. And in this case, the risk is very, very specific. It is absolutely crucial that you read the fine print. So we've got the reward, a stable, higher than average income. But what's the trade-off? What's that hidden risk that you're signing up for to get that extra yield? Okay, here it is. This is the big one. The key risk is something called the interest deferral clause. In plain English, if the insurance company's capital cushion drops below the legal minimum, they have the right to just stop paying you interest for a while. This is the single biggest risk you have to understand. And that right there, that's the twist. A normal corporate bond almost never has a feature like this. With those, the company's obligation to pay you interest is absolute. But with these life insurance bonds, that payment is conditional. It depends on the company staying in good financial health with the regulators. So, knowing all this, how do you invest in these bonds smartly? How do you avoid getting burned? Well, here's a simple checklist to help you weigh the risks and the rewards like a pro. First things first, you have to burn this fundamental trade-off into your brain. You are getting a higher yield, and in exchange for that, you're accepting the risk that your payments could be put on pause. Understanding that is absolutely step one to making a smart decision. Okay, here's what to look for. Your 3-point inspection. First, dig into the insurer's asset quality. What are they investing in? Is it safe, boring stuff, or risky, speculative assets? Second, check out their profitability. Is this a company that's consistently making money year after year?
And third, and this one is the most important, check their capital adequacy ratio. This number tells you exactly how big their safety cushion is above that legal minimum. The bigger the cushion, the lower the risk that they'll ever have to pause your payments. So, there you have it. Life insurance bonds. They offer this really unique blend of stability and higher returns, but it comes with a very specific risk attached. The question isn't whether they're good or bad. The real question is whether their unique risk-reward profile is a good fit for your financial goals. Is that extra yield worth the risk of a paused payment? Well, that's a question only you can answer.